Welcome to the Monday Futures Market Outlook for November 21st, 2011. This is Patrick Sresna. For those of you that have not had the opportunity to try out the eMiniSource.com trading room, 5-day complimentary memberships are available on the website. As always, we start off with a weekly chart of the S&P 500 going back 3 decades. When we plot an 80-week moving average on there, it does a very good job to depict the bull and bear market cycles that we've gone through. We've just recently experienced substantial whipsaws. We've crossed below that 80-week moving average, back above, and now, as of this morning, we're trading back below it. This whipsaw obviously is being driven by the news coming from Europe, but recognize that so long as we are trading anywhere below this 1215 area or so on the downside of the S&P, that we are in bear territory from this indicator's perspective. Just to quickly review some key intermarket observations, over the last 4 weeks we have been distinctly bullish, particularly based on seasonality, based on as well the fact that the market has put in a substantial bottom and had a very strong impulse move off that low. But recognize our thesis will be put to the test this week. The deteriorating European markets are stirring up investor fears. If the European fears continue to push money into U.S. dollars and particularly into U.S. Treasury bonds, it will trigger traders to reduce their equity exposure and sell the broader markets. It's an indication that money is flocking to safety and leaving the risk assets, and this would be generally construed bearish. Also, for the first time in 6 weeks, our market breadth indicators that we track have given bearish signals, which again are indicating broader distribution. Now there's critical support that lies around the 1160, 1180 area on the S&P, which we'll talk about on the next chart. But recognize that if the Treasury bonds here continue to hold a breakout strength and the U.S. dollar continues to strengthen, the intermarkets will naturally weigh against the stock market. When we take a look at that S&P 500 on the daily charts, you can see that we've now broken below the 1210, 1220 support lines. In fact, the chart doesn't show that in the morning here that the markets are trading as low as the 1195 area on the downside. We've been up till now talking about the fact that this little wedging formation could theoretically have and go down even as low as the 1160, 1180 area on the downside, and just being a natural Fibonacci retracement before actually creating that wedge and then a bullish breakout on the upside. But that entire thesis, like we were saying, is going to be substantially put to the test this week, as a lot of those European fears can especially if driven from broader intermarket relationships, creates a very rapid distribution within the markets. We could find ourselves in sell mode very quickly. And so while we're trying to be cautiously optimistic about these support lines, we're also recognizing the substantial risk that's coming in the market selling down to these levels. Next year, when we take a look at that U.S. dollar index futures, the U.S. dollar continues to strengthen a little bit this morning as well. It's actually been moving up towards the higher end of the last 2 trading days. At this juncture, if the U.S. dollar bullishly breaks out above 79, it'll head right back up to the previous highs around the 80, 50 area on the upside. This would be very natural if money is leaving that Eurozone and looking for safety in places like the U.S. dollar. And so we'll be watching very carefully whether or not the U.S. dollar strength continues. It certainly would not bode well for the markets if that was the case. Next year, I want to take a look at copper futures. And copper, we've been also optimistic about holding support lines around this 330 area, right around its Fibonacci retracement zones. But again, we were thinking that a bullish breakout here on copper could happen. But if again that situation in Europe continues to substantially deteriorate and we get U.S. dollar strength, it might be signs of global economic slowness, which copper would certainly deteriorate all the way back to its previous lows under that environment. Anywhere really below 330, we have to really become far more neutral, if not downwards bias, and only on a bullish breakout above 350 would we really start to be again more optimistic about copper. If copper remains sort of in trade range bound between that 330, 350, or stay relatively neutral and let the price action break give you an indication which direction it's going to head. Next year, when we take a look at the chart on crude oil came right up into our 100, 103 focal point, right where all the highs came in that May, June, July cycle, and subsequently very quickly gave back that last leg of the rally. At this juncture, if the US dollar strengthens, we will see that retracement in crude oil, which could very easily come and retest that 90-92 level on the downside. Now, overall, crude oil has been far more bullish than a lot of the other commodities, but really at this juncture, at least a very natural Fibonacci retracement in crude oil is not out of the question here. Next year, when we take a look at gold futures, gold is sort of at a very important moment at the 1700 to 1730 focal point. Really, at this stage, we were still of the opinion that gold could strengthen so long as it holds above the 1700 level. If we find a major support here on gold, particularly if it's used as a hedge against global economic slowness, then we could see that 1700 level hold and gold attempt another push higher. But realistically, gold has really been more traditionally a hedge against the US dollar, and right in here we have the potential for US dollar strength. If under that environment gold weakens, then it will break below 1700, and below the 1700 level we're going to take a far more neutral, if not even bearish bias on gold at that level. So we're going to be watching early on Monday and Tuesday to see whether or not gold holds these types of price levels. If again if the bulls can hold 1700, we'll remain open to the idea that gold can trade all the way up to the 1900 level, but below 1700 we're going to take again a far more neutral to bearish bias on gold. What's particularly supporting a more bearish bias is the fact that silver has been continuing to be relatively weak, and the weakness in silver being directly related to gold as a precious metal may spill over and create some weakness in the gold market. Finally, I want to take a look at the 30-year Treasury bonds, and this is really where all of the major concerns are coming from, recognizing that the Treasury bond market is substantially larger than the stock market. As investors flow money into Treasury bonds at these historically low yields is an indication of them seeking protection from other risk assets. Really, at this stage, we were talking about this 142, 143 area marked off by this blue box, and so long as Treasury bonds here bullishly break out above that zone, then we're going to see the yields on these Treasury bonds dropping below 3%. That would be an indication that money is flowing back into these Treasury bonds for safety, and that would certainly be a very poor sign for the stock market and the broader markets. We're watching again whether or not we're going to have substantial US dollar strength and Treasury bond strength. If we see that, that's an environment from which it would be very difficult for the stock market to make any progress. Any bullish breakout on Treasury bonds, we could see just simply a retest of the previous highs around the 147, 148 area up along the upside, but there's nothing stopping a full bullish breakout of Treasury bonds even up to the 152 to 154 level on the upside. That would certainly be done in an environment from which the stock market is going through a substantial repricing. That was your Monday Futures Market Outlook. Thank you for joining me.